Today we have Peter Oszkó, partner of O3 Partners, and we will be talking about the CEE region as an opportunity for secondaries, right? Yeah. So Peter, tell me a little bit. The CEE is often described as like undercapitalized, no? But high growth and very attractive market. From your perspective, why this is the right moment for a secondary strategy focusing?
Because there are not that many players in the secondary market of Central Eastern Europe, especially because the funding comes still mainly from public sources. So it's undercapitalized because private savings are not very active. There are limited private savings and they are not taking the risk of entering into the venture capital business. So some private money are co-funding VC funds, but VC funds are mostly managing public funds. These are regulated funds with regulated investment policies. And public funds are not really open to finance secondary type of investments. They consider themselves as a development funding to support early stage ventures. And they don't really like secondary type of funds which are giving the money to other investors or investing in other structures. And there are very limited number of secondary market players there. Coming from that market, what we see that there are a lot of regulated funds with regulated investment policies where they need to close at the same time. There are same vintages. For instance, in Hungary, in 2010 and 2011, 30 new fund managers started EIF co-financed regulated funds, and they had the exit period just at the same time. So 30 fund managers tried to sold all the portfolio companies 10 years later. In a market which is anyway very undercapitalized, and global investors are very cautious with that. So that's a heaven for a secondary investor, where we could start selecting the best companies, just refinancing the initial investment with some private money and helping them to go to an exit later. We just started the secondary business in 2018 and did a lot of secondary investment between 2018 and 2022. And we did much better returns on the secondaries than on the initial early stage investment. So we did 10x return in 4 years' time, which was very attractive. And this is what's coming again, because the next generation of regulated funds just started their activity from between 2016 and 2018. So they just have the same exit period right now. This is what we want to do now, that we go back with a new secondary fund and then try to use that market opportunity. And we are just wondering why there are no other market players doing that, because it's such an obvious business.
But as you said before, the CEE is a very special region. Like you have to know it, you have to know this.
We need to have the local knowledge. We need to know all the fund managers. We need to know the portfolio companies in order to select the proper portfolio companies, the proper investment targets. But that's always the case for early stage investments. You need to have the local knowledge. But as I said, I mean, the business rationale of that activity is pretty obvious. We are very happy that there are still not that many players on our side from the secondary fund managers, but we try to use that market opportunity again. And of course, this is also helping the whole ecosystem, because the fund managers have the opportunity to exit, and founders have the opportunity to build the companies further and try to achieve a successful exit.
And maybe can you tell us a little bit more about O3's secondary strategy, and what's the current situation in your fundraising?
I explain what we are doing overall, because O3 Partners' overall strategy is being a GP state investor. We started with early stage investments 15 years ago, and as I said, we were very successful then with the secondary investment. And as we do the secondary investments, we talk to a lot of other fund managers. And then with other fund managers, we just realized it makes sense to start consolidating the market, put together different fund strategies and create a family of funds. So now in the family, we have early stage growth capital cycle of fund managers as well, and we still continue the secondary type of investment. On top of that, we are a listed company, so we get funding from the public markets actually. So we have retail investors, high net worth individuals, institutions, investors, mostly from the Central Eastern European region. And that's how we can get new funds. We can start funding all new funds and try to invite investors from our network, from our existing network. That's who we are. We are managing more than 300 million by now. And an important part of that portfolio is the secondary type of investment. With early stage, we are most active in the Central Eastern European region, because as we just discussed, you need to be there. You need to have the local connections, the local knowledge to be in the early stage. With growth capital, we are active in the Nordic countries and as well in the DACH region as well. So the growth fund is active in more regions. In the secondaries, again, they are mostly connected to the Central Eastern European region. That's a very unique secondary market, as I explained, because you need to work with fund managers and you have the opportunity to take over full fund portfolios as well. But of course, you need to have specific knowledge about the market and about the portfolio companies.
Yeah, I mean, I think that this is an industry of access, no? And for secondaries, it's even more important, no, to have access to those deals.
Yeah, definitely. In the secondaries, the most difficult part is about the real value of the company and about the valuation, about the potential discounts, and about the sharing of the future profits. And for that, you really need to know what is the actual position and what are the prospects of the company. It's no longer about a vision, because in early stage you just invest into a vision and into a team. In the secondaries, there is already a story. The companies try to do something for 6-8 years. The fund managers try to exit, and the two of them try to sell that to a secondary investor. But now, if you are totally new and you don't know anything, of course you again buy a vision. If you were present on the market, you knew the funders already in the past 5 years. You heard the stories, you knew what was the initial dream and then what they achieved, then you are in a much better position to just give a proper valuation and have a proper deal with them.
And in this cycle situation that you're saying, no, that makes it very specific, the CEE is special, no, because it's you need to sell.
There are waves of exit pressure on the fund managers. Yeah.
And what's like the discount component? Like, is it
In secondaries, it's always an important part of the deal to have a discount, because this is why it becomes attractive for a secondary investor. The discount gives more motivation to the funders, because after a certain time there is a pressure on the liquidation preference, that how much exit they can still get. When we take over an original investor with a discount, it means that there is a better chance to have proper share of exits for both parties. But we most often do that, we give an offer for a discounted price, but we give an earn-out to the original investor as well. So we say that that's the value we are ready to accept and invest. We also have a return expectation, but anything is above on that return expectation is to be shared with the initial investor, because they accept the write-off and to give the shares for a discounted value. But if we have a brilliant exit at the end of the day, which we had many times, then we are still happy to give it back to the initial investors as well. And this is how the discount is a bit easier to accept, because they still have a potential share for the exit. Of course, in a secondary deal, the most important part of the deal is the valuation of the company you take over and the potential discount. That's how we make the money, that we can take over companies at a discounted value. We can still increase the valuation and then get to an exit in 3-4 years' time. Exit periods are much shorter and the return potential is very attractive. But for that, you need to have a proper explanation with the founders, with the previous fund manager, what is the real value and what discount should be allocated to the deal. For that, we need to know the deal, we need to know the company, we need to know the history, we need to know the founder. This is why it's much better that we are anyway on the market. We knew the initial story, we knew the vision, and we understand what they've achieved, but we need to motivate all the players as well. Founders are normally happy with a secondary deal because they get rid of all the liquidation preference or the existing pressure from the past years, and they can just restart the story. The fund managers who sell the company, accepting a discount is not easy. But on the one hand, they need to close the fund, and having a certain exit value is better than not having anything. On the other hand, we try to make fair deals, and what we generally do, that we offer a discount, we set a return expectation for our own exit, and if there is an exit above that return expectation, we just offer an earn-out to the initial fund managers as well. So we say that if ARR or the IRR is over 30%, of course, we are happy to give back a certain part of the exit value to the original fund managers, because they had to sell the investment with the write-off with a certain discount, and that makes more easy to conclude a deal, because then everybody has his own motivation. Funders can have the option of still growing the value and having an attractive exit. The previous manager have a certain liquidity out of an exit and still have an upside potential. And then for us, it's a good deal from the beginning. But we experienced that we could really have exits after 3-4 years with very attractive multiples.
And have you been able to give the upside to the previous?
Yeah, it happened many times. I mean, if we just look at our best deals, it happened that we did 16x after 3 years, which is a very significant return. Or we had in another case, we had 10x after 4 years, but still it's very attractive. So sometimes the IRR is over 100%. And then out of that, of course, you can give back to the previous fund managers a certain earnout share as well.
And being such a no-brainer, what do you feel like? How do you think are the conversations with the LPs? You know, because it seems like a no-brainer, but on the other side, you have to.
Still, Central Eastern Europe, it's not that easy to sell to the LPs. Of course, they understand the numbers, but they are still cautious with the region. They understand that we are local, but this is why also they don't feel comfortable how much they understand themselves out of the market. But as I perhaps mentioned, we are a listed company. We have many shareholders, we have retail investors, we have high net worth individuals, we have institutional investors. So we have many investors from the region. Of course, they understand why the region is interesting because they are also from the region. And as this structure gives just a participation in a listed company, which is continuously profit-making with very attractive total shareholder return, we can just explain to the LPs that they can take part in a listed structure. That's the risk they run. And then the business behind is a lucrative business that we are very good in and we have a very good track record.
And also you work with an evergreen structure.
Yeah, and in the secondary business, we don't operate in a closed-end fund because the exit periods are much shorter and the money is turned back much more quickly. And what we've agreed with our investors that it will be, or it is already an evergreen structure, meaning that those LPs who just want to have continuous profit repayment, they can just enjoy dividend payments regularly. And those who want to exit after a certain time, there are always share repurchases that they can use for increasing their liquidity. So it's always subject to the decision of the LP for how long they just stay in the fund and how quickly they want to exit and get their money back with a proper return.
Wonderful.